Welcome to the Credit Concept, the Concept of Credit podcast. My name is Credit Coach Nicole Scott. I am your host. If you are interested in learning more about credit, you are definitely going to want to subscribe to this channel and follow us on all of the social media platforms at Credit Coach Nicole Scott, Instagram, and YouTube. You can also follow me on TikTok at Credit Coach Nicole, where I talk about personal credit and business credit to help you leverage your credit. In today's podcast, we're going to be talking about the importance of a mixture of accounts. Now, I have talked about the concept behind credit and why it is so important. So make sure that you have watched all of the different episodes that are under the Concept of Credit podcast. Now, today, we are going to be talking about, why it's important to have different types of credit accounts on your credit profile, and what does it mean when they say you have to have a mixture of accounts onto your credit profile. Now, the mixture of accounts is going to be extremely important for you to understand the concept behind it, so that way you can really leverage your personal credit. Let's go ahead and get started with the importance of having a nice mixture of accounts on your credit profile so you can further build an extremely strong credit report that will literally give you the credit score that you desire, that you need to reach your goals. Now, I always tell people, you want to try to strive for at least a 720 credit score on all three of the credit bureaus. And if you watch all of our different episodes of the Credit Concept podcast, we literally give you all of the breakdown for how to structure your credit report section by section. So let's get into it, the mix of accounts. Now, there are different types of credit accounts that you need to have listed on your credit profile in order for a creditor to really say, hey, we think we can trust this person. They have credit cards, they have loans, and they have paid on time. We're willing to give them a shot as well because they have showed some great credit trends and credit history and payment history and, account management with these other accounts, and we want to give them credit as well because we know that we can make some money off them, and we feel like they would be a good consumer to take a chance on, right? So we want to have a mixture of accounts. What does that mean, right? Well, a couple credit cards, because credit cards are going to be considered revolving lines of credit, meaning they can change, they can revolve from month to month based on what your spending habits are. And we don't want to have high spending habits when it comes to our personal credit cards. The business side is different, but the personal side, we want to keep below 10% of our credit limit. So if the limit is $1,000, you want to keep the balance reported to the credit bureaus under 10%. Watch the other podcasts that talk about, the credit utilization to get more information on that. Now, there's another type of account which is considered an installment account. And this is the type of account where you pay installments amount until the balance that you owe that creditor is paid in full. So this can be an auto loan, a student loan, a mortgage, any sort of personal loan, any sort of loan, a lump sum of money that you have taken out and borrowed. You're going to pay back the same amount every month until that is paid off, right? Essentially, like sometimes with a home loan, it can change based on what the interest rates are. But typically, when you get an auto loan, the interest rates don't change unless you refinance it. So, if you feel like you're paying too much for your auto loan, you want to take a look at what your interest rates are. You want to work on improving your credit score so you can refinance loans, including auto loans, that have a high interest rate. Because a lot of times when we go and get auto loans or we go and get loans for certain things, we don't understand credit like we do now, right? Or like we're trying to understand, we're learning, right? Because this was not taught to us. So we're learning all of this. We're going to apply the knowledge. We're going to take action. We're going to do the things that we need to do that no one can control for us, like pay our bills on time, keep our credit card balances below 10% of the limit, meaning keep our credit utilization low, pay our bills on time, again, pay our bills on time. But we're also going to have, this mixture of accounts where we can show creditors, no matter if it's an installment loan or a credit card, I pay my bills on time and I can manage my credit properly. So you should give me a chance too, right? And it's always a good rule of thumb to have between 10 and 20 open accounts on your credit profile. And I know a lot of people might think, oh my God, that's so many, right? But it's really not, because say you have 10 accounts, right? That's really not a lot, because you have your auto loan, you have like maybe a personal loan, you have a couple credit cards, you could even have a couple store credit cards. I don't really recommend store credit cards because they're really just specific to that store. So it might, entice someone to go spend money that they don't necessarily need to spend at Best Buy or Sephora because they have a credit card there, right? The good thing is, on the flip side, that a lot of these companies are underwritten by bigger corporations like Synchrony Bank, which is, an underwriter for a lot of different places. So we're building good relationships with these banks and financial institutions. However, if you don't have a budget, and I talk about budget in one of my podcasts, make sure to listen to the credit utilization podcast where we talk about budgets. If you don't have your budget, you're going to overspend every month. And you have to write your budget down, and you have to give yourself some room. If you are one of those people that has to have an entertainment budget every month, then give yourself some money for entertainment, but limit it, okay? If you're one of those people that has to buy makeup every month, give yourself a budget for that makeup every month and say, look, I can't spend over this. So sometimes I'll have to wait till it's on sale or whatever the case may be, but leverage it so it meets your budget, which is your financial blueprint, okay? Which is setting up our foundation, okay? Because the last thing that we want to do is get a bunch of credit cards and we don't have good spending habits. The credit card is burning a hole in our pocket, so we feel like we have to go use it. And believe me when I tell you that it is very easy to allow credit card debt to get out of control. Okay, it could happen to anybody because you think, well, I'm just going to spend this and I'll pay it off. I'm just going to spend this and I'll pay it off. I don't have the money yet, but I'm going to get it, right? I'm going to get the money. No, we can't spend what we don't have. Okay, that's one thing that you have to understand, because the way that the report works is, when you spend something, you're going to have to pay it prior to the statement date, or it's going to affect your credit, right? If you just get a credit card and you're already spending a bunch on it, it just doesn't look good. Why do you need to spend so much money? You should not be spending more than 10% of the available credit limit, okay? And you have to understand the concept behind it, because a lot of times when people give you a credit card, it's not for a big amount. It's maybe $1,000, $500, no more than $2,500. So you're burning your chances of getting high limit credit cards. You're burning your chances of getting a home. You're burning your chances of getting whatever car you want and being able to leverage your credit to buy whatever you want, because you're ruining it over these petty credit cards. But people don't understand the concept behind it. You have to understand the concept. These low limit credit cards are simply a test. Are you going to mess up your credit and your finances over $500 or over $1,000 or over a couple $100? If so, you can't be trusted. Okay. And if so, we don't feel like you would be a good fit for our credit program. Okay. You don't have the credit requirements and criteria to qualify. And a lot of people when they look at your credit report, they're not going to tell you, oh, well, in order to qualify for our program, you have to have a 680. No creditors or banks or lenders out there are necessarily going to tell you what their credit score requirement is. And the reason behind that is because there is no score. It's the information that's on your credit report. It's the concept behind the data. Okay. And right now you got to be focused not on your credit score, but on data points, right? Because your credit score is going to go up and down. But as long as you understand the concept behind credit and the data points that you need to achieve in order to optimize your credit score, then the credit score doesn't matter. Because okay, well, I had to take a little dip here because of this or because of that, right? But now I'm going to fix this, and maybe I'll add trade lines or pay down my credit utilization, or try to add rent reporters so I can add some age organically, or just apply for more credit because I need to have more of a mixture of accounts. Right now I have too many installment loans. I don't have enough credit cards. Whatever the case is, we got to understand the concept behind credit. And when it comes to the mixture of accounts, we want to show that we can pay our installment accounts on time. We can pay our car note on time. We can pay our student loans on time. Even if they're in, forbearance right now, they are still reporting positive. We just need to make sure that when they become out of forbearance, they're still being paid positive. And a lot of people need to understand that they need to make sure they're staying up to date with what's going on with their student loans. Don't assume that these student loans are just automatically going to be forgiven. Every situation is different. Understand the concept, okay? Yes, there will be student loan programs, but you have to qualify, okay? How do you qualify? Call the servicer who is servicing your student loans and ask them if you qualified and where's the application to fill out to see if your loans qualify, okay? If your loans don't qualify, whatever the case is, while they're pending qualification, you need to make sure that your student loans are in good standing. You are making payments on time. You have arranged some sort of payment arrangement to make a small affordable payment. And you have done that because you want to make sure that these accounts remain in good standing. And that's for every type of credit account. You have to understand the concept behind it. If you have accounts that belong to you that are valid, we need to get them in some sort of good standing, okay? For the most part. You can dispute it. If they can't prove it, they got to remove it. However, if they are able to prove that this belongs to you, then you need to turn that positive, that negative account into a positive by coming up with a payment arrangement and settling it. And that is going to bring me to my next podcast. So our next podcast is actually going to be about settling accounts. So you want to make sure that you stay tuned for that. But, back to the mixture of accounts, we just want to make sure that we have, at least, I would say, a good mixture of accounts. If now I'm speaking from myself and I have, one of my credit scores is like an 807 right now. So I can say that honestly, I would recommend more accounts. The more accounts you have open and in good standing, the better. And I'm going to tell you guys how many accounts I have open. So I have 48 total accounts reported on my credit report. So I have a very strong credit profile, right? But about half of those are closed because some of them are credit builder accounts that I've used, like 𝓔𝓏, self-lender, pledge loans, secured loans, different type of credit builder loans. And those are okay to close. We just don't want to close credit cards because they have the history. So I have about 20 current trade lines that are open, reported on my credit, and only a very few amount of them actually have a limit. I do not carry limits or balances on any of my secured credit cards. It's just simply not worth it. We use that, the concept behind a credit card, a secured credit card, is to use it to obtain better credit cards and better relationships with financial institutions like credit unions or even community style banks that can offer you better credit products. Okay. But, the mixture of accounts is, we don't really want to have more than 4 installment loans. Now, if you have a bunch of student loans, that's okay, but 4 installment loans. So if you have a student loan, I really only count student loans as one, even though they might be several, because it's like a type of account and it's government. So we don't want to have more than like 3 additional types of installment loans, because that means that you have a lot of debt. But you can have like an auto loan. I don't recommend buying an auto or getting an auto loan before you get your house. You definitely want to get your house first before you would get an auto loan, because you don't want to add more debt to your credit profile. But any sort of personal loan, student loan, auto loan, that is going to be considered your installment loan. So you want to have no more than 4 of those, right? And you want to definitely have some history of some closed out ones that show you've paid the balance in full. So if you have more, but some of them are closed, that's okay. You don't want to have more than 4 open ones, okay? And then the rest of the accounts should be credit cards, primarily Visa, MasterCard, American Express, Discover, cards that are going to be a good relationship type of card, cards that are with places like Navy Federal, cards that are with places like Goldman Sachs, because they are the Apple card, and you can also do GM Financial, and that can also tie over to the business relationship as well. PenFed, which is Pentagon, Financial Credit Union. There's cards that are like fintech credit cards that you can start building with, like Tomo and Pedal. And then of course there's places like secured cards that graduate that are great to work with, like Discover they graduate after 7 months. Navy Federal has a secured card that graduates. You can also do secured loans with credit unions. I know PenFed has a secured loan. Navy Federal has a secured loan called the Pledge Loan. And I have a bunch of videos on my YouTube channel that talk about that. So you want to make sure that you follow me on YouTube and watch all of my videos over there as well. But there are a lot of different types of accounts that you can get to start building your profile and giving you a stronger credit profile, stronger credit score, right? Building credit. I actually have a video on YouTube that goes over how to build credit. So you definitely want to watch that, but understand the concept behind the mixture of credit accounts and what type of credit accounts you need, because you don't want a bunch of installment loans and no credit cards. Installment loans are much easier to get, because an installment loan is like the loan that you get with self-lender, pay monthly on, right? And then they might offer you a secured card. I'm not a huge fan of their secured card unless it's absolutely required, because they don't graduate and there's nothing much of a benefit that they can offer you. I'd rather take that money and put it into Navy Federal with a secured loan. So that's, the concept behind it. But if you do Credit Strong, that's an installment loan. If you do a secured loan with a bank or financial institution, that's an installment loan. So you don't want to be too heavy on the installment side and then too light on the credit card side. You want to have a nice balance between the two, even if they're half, but it really should be like 80-20, 80% credit cards, 20% installments. That's a nice mixture, because if you can have more installment loans that are showed as paid and closed, that's great. I'm talking about open, right? The more you show paid is great, but as far as open, you don't want to show that you have a bunch of debt, especially when you're going to purchase your first home or apply for a home. You want to make sure that, you have the requirements, which are typically 2 years worth of history, okay? They want to see credit cards that have been open for 2 years, perfect payment history, accounts that have been open for 2 years, perfect payment history. So again, guys, I appreciate you sticking around for the end. If you found value in this video or this podcast, I should say, make sure that you have followed us on all of the platforms where we talk about the concept of credit. I am your host, Credit Coach Nicole Scott. Make sure to follow me on Instagram and YouTube at Credit Coach Nicole Scott. Until next time, take care.